What if I told you that the company that hosted your virtual family trivia nights back in 2020 is now actually deploying artificial intelligence to completely replace human cold callers in Japan?
I mean, yeah, it is a massive cognitive leap. If you are still evaluating this company as just a simple video conferencing tool, you are fundamentally mispricing the asset.
Right. Welcome to the deep dive. Today, we are looking at how a company pulls off, well, arguably the hardest maneuver in the tech sector, which is
escaping its own legacy.
Exactly. Escaping its own legacy. We have a very specific mission for you today. We are breaking down Zoom's Q1 fiscal year 2027 earnings call.
Yep. Ticker symbol ZM.
Right. ZM. And we have the transcript, we have the financial statements, the management guidance, all of it. But we aren't just going to sit here and read you the numbers.
No, that would be incredibly dry.
So dry. We are going to look at the actual mechanics of the business, translate the Wall Street jargon, and really figure out if this pivot from a video pipe to an AI workflow engine is actually working.
And, well, spoiler alert here, the data suggests it really is. But to understand why, we have to look past those surface level narratives,
Right.
We're going to take an objective, heavily analytical look at these results and outline exactly what this means if you are holding or considering a position in Zoom.
So let's start right where the market starts, right?
Yep.
The headline numbers, the top line and the bottom line. Are they actually beating Wall Street's expectations?
Let's dive into revenue first.
Yeah, let's hear it.
So total Q1 revenue came in at $1.24 billion.
Yeah.
That represents a 5.5% year-over-year growth rate, or if you look at it in constant currency, it's 4.6% growth.
Right.
And most importantly, for the market's immediate reaction, that $1.24 billion, it beat the high end of management's own guidance by $14 million.
Let's pause right there, because we need to define some of these terms so we're all operating with the same mental models here.
Mm-hmm.
You mentioned constant currency.
Mm-hmm.
Why does that actually matter to a software business?
Well, it is crucial for any global business, honestly. Constant currency strips out the fluctuations in foreign exchange rates.
Okay, so it removes the noise.
Exactly. Think about it this way. Zoom sells software all over the world, right?
Right.
So if a company in Europe pays Zoom, let's say 100 euros a month, last year, that 100 euros might have converted to 110 US dollars.
Okay, makes sense.
But if the US dollar gets stronger, this year, that same 100 euros might only convert to 105 US dollars.
Oh, I see. So Zoom didn't actually lose a customer.
Right. The customer didn't downgrade their service. The underlying business is exactly as healthy as it was.
But on the US financial statements, the revenue just looks lower simply because of what macroeconomic currency shifts.
Precisely. So constant currency growth of 4.6% tells us the true operational growth of the business completely, regardless of what the currency markets are doing.
Okay, that makes perfect sense.
Mm.
Now let's talk about that 5.5% headline growth rate you mentioned. Because I know a lot of people are going to hear 5.5% and think, wait a minute, this is the ultimate hyper-growth tech darling.
They used to grow at triple digits.
Right. So 5.5% sounds like a mature, slow-moving utility.
It does, yeah. If you are anchoring your expectations to 2020.
Which a lot of people still do.
They do, but comparing any modern metric to the pandemic anomaly is just a trap. You have to evaluate the business in its current macroeconomic reality.
Fair point.
And what's fascinating is that management explicitly noted this is one of their best growth rates in recent quarters.
Right away.
Yeah. I mean, they are steering a massive enterprise that basically had to physically stabilize after a historic, completely unnatural demand surge.
Right. They absorbed like a decade of growth into a single year, and the hangover from that was always going to be brutal.
Exactly. It was inevitable. So taking a $1.24 billion quarterly revenue base, defending it from churn, and actually growing it by 5.5%.
While simultaneously rebuilding your entire core product offering around AI.
Right. That requires incredible operational discipline. They aren't bleeding out. They're finding their footing and slowly reaccelerating.
Okay, so the top line is steady. It's solid, but not exactly lighting the world on fire. But then we look below the deck, we look at the bottom line.
Profitability.
Yeah, the profitability. And this is where the financial engineering starts to look genuinely remarkable.
Let's get into those metrics because they really are the strongest part of the quarter.
Hit me with the numbers.
Non-GAAP diluted earnings per share, or EPS, came in at $1.55.
Okay.
They beat their own guidance by 13 cents. And that is up 12 cents from the exact same quarter last year.
So we have to unpack non-GAAP diluted EPS for a second.
For sure.
Because Wall Street analysts throw that term around constantly.
Right.
And it hides a lot of mechanical truth about a business. Let's start with GAAP versus non-GAAP.
Well, GAAP stands for Generally Accepted Accounting Principles. It is the standardized, rigid rulebook for accounting. Every public company has to report GAAP numbers. But companies also report non-GAAP numbers, which is basically management saying, hey, if you ignore these one-time costs or non-cash expenses, here's how the actual day-to-day business performed.
Right. And the biggest thing tech companies exclude in their non-GAAP numbers is stock-based compensation, right?
Precisely. Tech companies pay their engineers and executives heavily in stock.
Which makes sense.
It does. It doesn't cost the company cash today, but it does dilute the existing shareholders.
Because there are more shares out there.
Exactly. GAAP forces you to count that stock as an expense. Non-GAAP allows you to ignore it.
Okay.
So when Zoom says their non-GAAP EPS is $1.55, they are showing you the pure operational cash generation of the software before accounting for the stock they gave to their employees.
Got it. And the diluted part of EPS?
Diluted just means they are calculating the profit per share while assuming every single stock option, restricted stock unit, and warrant out there has been cashed in.
Oh, so it's the most conservative way to look at it.
It is the most conservative way to look at the pie, yeah. Assuming the pie has been cut into the maximum possible number of slices.
Okay.
So generating $1.55 in profit per slice on a fully diluted operational basis is a massive beat.
It really is. And, the non-GAAP operating income was $509 million, which is up 9% year over year.
Yeah.
But let's look at the margins. When you look at the margins Zoom is operating with, it fundamentally changes how you view the company.
We are talking about a 41.1% operating margin.
Let's give some context to that for you listening. Because if you look at a mature, highly successful software as a service company, like a standard SaaS business,
right,
they're usually thrilled to hover around a 20% to 25% operating margin.
Absolutely thrilled.
But Zoom is running at 41.1%. How is that even mechanically possible?
Well, it really comes down to the fundamental architecture of their network and just incredible cost discipline.
Okay, unpack it.
Let's look at their gross margin, which is hovering right around 79.9%, essentially hitting their long-term target of 80%.
Which means for every dollar they take in, it only costs them 20 cents to actually deliver the service.
Right. And for a video conferencing company, that is astonishing.
Because video is heavy.
Video is notoriously bandwidth intensive. It requires massive server infrastructure. But Zoom doesn't just rent generic cloud space from AWS or Google Cloud for everything.
Oh, they don't?
No. Over the years, they built their own highly optimized proprietary routing network specifically designed for video multi-tenancy.
Wow.
They own the core infrastructure where it matters, and they route traffic in a way that just minimizes external cloud computing costs.
So they aren't just a software layer sitting on top of expensive rented servers. They actually control the unit economics of the video pipe itself.
Exactly. And because they have optimized the cost of delivering the videos so intensely, the gross margin is pristine.
That makes sense.
Then you look at their operating expenses, sales, marketing, R&D. They are keeping those tight, which allows that 80% gross margin to filter down into a 41% operating margin.
Which leads us to the ultimate metric of corporate health, right?
Yeah.
Free cash flow. The free cash flow margin sits at 40.4%.
Yeah. Free cash flow is the ultimate truth teller in finance.
Because you can't fake it.
You really can't. You can massage earnings, you can adjust GAAP and non-GAAP, but free cash flow is simply the cash you actually generated from operations minus the capital expenditures.
The physical stuff.
Right, the physical stuff you had to buy, like servers or office buildings. It is the actual, tangible cash left over that goes straight into the corporate bank account.
And in real dollars, what does a 40.4% free cash flow margin mean for Zoom this quarter?
It means they generated roughly $500 million in pure free cash flow in 90 days.
That is insane.
$500 million of cash added to the balance sheet in one single quarter.
That is the metric that should make investors pay attention. I mean, when a company is generating $500 million in free cash every 90 days, they have immense strategic optionality. They aren't dependent on the credit markets. They don't need to raise debt at high interest rates. They are entirely self-funding.
And that cash generation is the exact reason why we need to move past the headline numbers and look at the structural changes inside the business.
Because that cash isn't coming from where it used to come from.
Right. We need to dissect the underlying business drivers. If you want to understand Zoom today, you really have to split the business into its two main customer segments: Enterprise and online.
Okay, let's start with enterprise because this is where the heavy lifting is happening.
Oh, absolutely.
The enterprise business now makes up 61% of their total revenue, and it is growing at 7.2% year over year.
And for you listening, if you are evaluating a B2B SaaS stock, you don't just look at the total number of customers.
No, you look at the big spenders, the whales.
Exactly. Because landing 100 small businesses paying $20 a month is great, but landing one multinational corporation paying $1 million a year, that is how you build a durable, high-margin software empire.
And the data on Zoom's whales is incredibly strong here. Customers contributing more than $100,000 in trailing 12-month revenue grew by 8%.
Yeah.
These high-value six-figure customers now make up 33% of Zoom's total revenue.
Let's explain that term you just used, though. Trailing 12-month revenue.
Yeah, please do.
It's a way of smoothing out the data instead of just looking at what a customer spent in a single 90-day quarter.
Which could be spiky.
Right, which might be artificially high if they just bought a bunch of hardware or low if they delayed a renewal. You look at their total spend over the last rolling 365 days.
Got it.
It gives you a much truer picture of a customer's annual value. And the fact that the number of these $100,000 plus customers grew by 8% tells you that large corporations are standardizing on Zoom.
Standardizing, yeah. And there's another metric in the enterprise segment that is vital to understand.
The net dollar expansion rate.
Yes. The trailing 12-month net dollar expansion rate for enterprise customers improved to 99%.
Let's do a quick ELI 5 explain. I'm 5 on net dollar expansion rate.
Yes, because it is arguably the single most important metric for a subscription software business.
Okay, so imagine you have a bucket of customers. Let's say exactly 1 year ago, in Q1 of last year, you had a cohort of enterprise customers who collectively paid you $100.
Okay, $100.
Now, fast forward a year, some of those customers went bankrupt. Some switched to a competitor. So you lost some of that original $100.
So you lost $10.
Right. So you're down to $90.
Right.
But the customers who stayed, the ones who love your product, they didn't just renew, they upgraded.
Oh, like they bought more licenses because they hired more people.
Exactly. Or they bought add-on products. So those remaining customers spent an extra $9 in upsells.
So you have $90 from renewals,
Yeah.
plus $9 from upsells, bringing the total value of that original cohort to $99.
Exactly. Your net dollar expansion rate is 99%.
Makes total sense.
What this metric measures is how much revenue you retain from an existing group of customers over a year without factoring in a single brand new customer.
And 99% is a very telling number, right? Because in the hypergrowth SaaS world, you often look for a net dollar expansion rate of 110% or 120%, meaning the upsells vastly outpace the cancellations.
Yeah, typically.
But a 99% rate for a company of Zoom's scale is still incredibly solid.
It really is.
It means the enterprise bucket is practically watertight. They are retaining nearly every single dollar of revenue from their massive existing base before their sales team even signs a new logo.
It proves that Zoom is not a discretionary tool that IT departments cut when budgets get tight. It is embedded infrastructure.
Okay, but I'm going to push back here.
Go for it.
We just established that the enterprise business is solid, but let's look at the other segment, the online business.
Right.
This is the legacy consumer base, the prosumers, the small businesses. I dug into the transcript, and the online average monthly churn actually ticked up. It went to 3.0% compared to 2.8% in Q1 of last year.
That is correct. It did tick up.
So let me challenge the bullish narrative for a second here. Let's compound that 3% monthly churn. If you lose 3% of your customer base in January, and then 3% of the remaining base in February, and so on.
Yeah.
By the end of the year, you have lost roughly 30% of your entire online customer base. Replacing a third of your customers every single year just to tread water sounds like a catastrophic leak in the hull. How is that sustainable?
It is a critical challenge, and honestly, it's exactly what the institutional analysts zeroed in on during the Q&A portion of the earnings call.
Because it's scary.
You are entirely correct on the math. A 3% monthly churn is a structural headwind. But you have to look at the composition of that online business.
What do you mean? What's the composition?
The online segment is highly bifurcated. You have micro businesses and individual contractors, say a freelance consultant who buys a Zoom license for a specific 3-month project and then cancels when the project ends.
Okay, yeah.
That is inherent structural churn. You are never going to retain that user for 10 years.
Because their need is just episodic.
Exactly. But within that same online bucket, you have smaller permanent businesses that simply purchase through the website rather than dealing with an enterprise sales rep.
Oh, I see.
The CFO, Michelle Chang, she addressed this directly. She called the move from 2.8% to 3.0% a nominal uptick, and basically advised analysts not to extrapolate a death spiral from it.
But why not? I mean, if the math compounds, why shouldn't we panic?
Because they're actively changing the unit economics of the online segment to compensate for the churn. They are focusing on higher lifetime value, or LTV, customers.
Oh, so?
For example, they are pushing annual billing cycles instead of monthly. If you lock a small business into an annual contract, you instantly break that 3% monthly churn cycle.
Right, they can't churn in month 2.
Exactly. Furthermore, they are migrating new higher-priced products down into the online channel.
Right. Historically, the online portal was just for buying basic video meetings.
Yeah.
But now, you can buy Zoom Phone or specialized add-ons directly through the self-service portal.
Precisely. So even if they lose the episodic freelance consultant, they are upselling the permanent small business on a comprehensive communications suite.
So they get more money from the ones who stay.
Yes. That is why, despite the 3% churn, the total online revenue still managed to grow by 2.8% in the quarter. They are extracting more value from the sticky customers to offset the fluid ones.
It's basically accepting that the bucket will always have a leak at the top, but making sure the water you pour into the bottom is significantly heavier.
That is a very fair way to look at consumer-level sauce.
Okay, so the core business is stabilizing. Enterprise is strong. Online is managing its structural churn. But that brings us to the actual thesis of this entire deep dive.
A pivot.
The transition. Because the real story of this quarter, the underlying driver of future growth, is their massive AI monetization engine.
And this is where the narrative shifts from, defending legacy revenue to capturing new markets.
Every company on earth is slapping the word AI on their press releases. It is the defining buzzword of the decade.
Sure.
But Wall Street is starting to demand actual quantifiable revenue from these AI investments.
Do you want to see the ROI on all these expensive NVIDIA chips?
Exactly. And Zoom is one of the very few application layer software companies actually putting tangible AI adoption numbers on the board.
It's true. Let's look at their baseline offering, AI Companion.
The growth here is genuinely explosive. AI Companion paid monthly active users grew 184% year over year.
184%.
That adoption curve is nearly vertical.
And it is being driven by their new AI Companion 3.0 capabilities. They are rolling out features at a breakneck pace.
I want to highlight one specific feature that they mentioned on the call, which is MyNotes.
Oh, yeah.
It essentially acts as a personal AI note taker. And the data point they shared is staggering. They hit 1.5 million active users on MyNotes in just 4 months after launch.
Wow.
And they specifically noted that they excluded trial users from that count. That is 1.5 million people actively using an AI workflow tool.
This proves massive product market fit. This isn't just a gimmick feature that people try once and forget about.
Right.
It is a tool that fundamentally changes how an employee operates. Think about the mechanics of a corporate meeting.
Okay.
Historically, one person had to sacrifice their active participation to take minutes, record action items, and synthesize the discussion.
Or nobody takes notes and everyone forgets what was agreed upon by the time the call ends.
Which happens all the time.
Right.
What MyNotes does is sit natively within the Zoom infrastructure. It uses advanced large language models to transcribe the audio, understand the context, extract the action items, and automatically format it into a summary.
That's incredible.
It allows every single employee to remain fully present in the conversation, knowing the administrative burden is just being handled by the software.
But let's look at this through the lens of an investor.
Okay.
AI Companion is currently included at no additional cost for paid Zoom users. So if a feature is free, how does it actually make Zoom money? Where is the monetization?
That is the million-dollar question. And Zoom has a very specific two-pronged strategy for it.
What's the first prong?
The first prong is retention. By making the core product infinitely more valuable, you ensure that net dollar expansion rate we talked about stays near 100%.
Oh, I see.
If an entire company relies on Zoom's AI to remember what happened in their meetings, ripping Zoom out and moving to a competitor becomes a massive operational headache.
You are deeply embedding yourself into the company's organizational memory.
The ultimate sticky feature.
Exactly.
But the second prong is direct monetization through upsells.
Okay.
They are using the free AI companion as a Trojan horse to sell what they call custom AI companion and their Zoom customer experience products known as ZCX.
Let's break down custom AI companion. Because why would a company pay for a custom version when the baseline version is free?
Because enterprise data is highly specific and highly regulated. Let's look at the example CEO Eric Yuan gave on the call, Raymond James.
The massive financial services firm.
Right. They started with the basic AI companion, but in Q1, they expanded to custom AI companion across roughly 10,000 seats.
So what are they paying for exactly?
Two things: context and compliance.
Context and compliance.
A standard AI model doesn't know the specific internal acronyms, the proprietary financial products, or the unique organizational structure of Raymond James.
Sure.
Custom AI Companion connects directly to the company's internal knowledge bases. It understands their specific glossaries.
So when an advisor says, like, allocate to the XYZ fund, the AI actually knows what that is rather than just guessing or making something up.
Right. And more importantly, compliance. Wealth advisors operate under incredibly strict FINRA and SEC regulations.
Oh, yeah. They can't mess around with data.
They absolutely cannot have their client data fed into a public AI model to train future versions of ChatGPT.
Right.
They need absolute data residency, strict security guardrails, and compliance tracking. Custom AI Companion provides that secure, enterprise-grade sandbox. That is why a company will pay a premium per seat for it.
It's the classic land and expand sauce motion, but supercharged by artificial intelligence. You give them the taste of AI efficiency for free, and once they're hooked, you charge them to tailor it to their specific enterprise needs.
But as impressive as the custom AI upsell is, the part of the transcript that represents the largest total addressable market expansion is their data around the contact center.
The ZCX product.
Yes.
Let's dive into this, because this is where Zoom stops competing against basic video tools and starts taking on massive legacy infrastructure companies.
It's a whole different ballgame.
Management noted that 9 out of their top 10 ZCX deals this quarter included paid AI. And crucially, 8 out of those 10 deals were direct competitive displacements of legacy systems.
We really need to pause and appreciate the mechanics of that metric. 80% of their top contact center wins were not greenfield opportunities.
Meaning they weren't selling to a brand new startup that had no existing system.
Exactly. They went into an established enterprise, convinced the chief information officer to rip out their existing, entrenched legacy contact center provider and install Zoom instead.
Ripping out legacy contact center software is like performing open heart surgery on a business.
It really is.
I mean, it handles all customer complaints, all inbound sales, all support ticketing. It is mission-critical infrastructure. For Zoom to walk in and win 8 out of 10 times against the old guard is a staggering win rate.
It shows that the market is desperately hungry for modernization. Let's look at how contact centers traditionally operate.
Yep.
You buy expensive on-premise hardware from a legacy vendor like Cisco or Avaya. You route thousands of phone lines into a physical building. You hire hundreds of human agents, deal with massive turnover rates, and rely on clunky, disconnected software where the agent has to put the customer on hold for 5 minutes just to look up their account history.
It is a high-cost, low-efficiency model that every CFO on Earth hates paying for.
Exactly. And Zoom walks in and says, hey, we can move all of this to the cloud. But more importantly, we're going to wrap it in an AI layer that fundamentally changes the unit economics of your customer service.
And the most incredible example of this unit economic shift was buried in the transcript regarding a company in Japan called Rensa.
The Rensa use case is a paradigm shift.
Let's walk through what they are actually doing. Rensa is using Zoom Virtual Agent, or ZVA. But they aren't just using it to receive incoming customer complaints.
Nope.
They're using Zoom's AI to make outbound calls. Specifically, the AI is making outbound pre-confirmation calls for electricity and gas connections.
We have to stop and think about the mechanics of this. For decades, if a company needed to confirm thousands of utility appointments, they had to hire a massive business process outsourcing firm.
A BPO.
A BPO, yeah. They would hire a room full of human beings in a low-cost labor market, hand them a script, and pay them by the hour to manually dial phone numbers.
Humans who need breaks, who mispronounce names, who get tired, and who cost a lot of money in aggregate.
Right. And now, Zoom software is actively dialing the phone. The AI is speaking to the customer, recognizing their responses in real time with near zero latency, confirming the appointment, and instantly writing that confirmation back into the company's CRM database via an API.
Zoom is quite literally replacing human beings making cold calls.
And doing it with infinite concurrency. An AI doesn't need to hang up one call to make another. It can make 10,000 outbound calls at the exact same second. It follows the script perfectly every time.
The cost savings for a massive enterprise are almost incalculable.
It's wild.
I mean, if you are a CFO looking at your budget and you see a massive line item for an outsourced call center and Zoom proves they can automate 40% of those outbound administrative calls with software, it's not a hard sales pitch.
This completely redefines Zoom's total addressable market.
How so?
Well, if Zoom was previously just competing for the communications budget, trying to get the IT department to switch from WebEx to Zoom Video, they are now actively competing for the operations and human resources budgets.
Because they are selling labor replacement, not just communication infrastructure.
Exactly. And they are doing this across multiple verticals. They highlighted their Bright Hire tool, which provides AI-assisted recruiting workflows. They are embedding themselves so deeply into the fundamental operations of a company that the software becomes indispensable.
Let's look at a few other concrete examples they gave on the call, because it proves this isn't just a theoretical tech demo. Chelsea FC, the massive football club in the UK.
Right, a global brand with massive consumer engagement needs.
They didn't just buy Zoom Video for their executives to chat. They bought Zoom Phone, Zoom Contact Center Elite, and Zoom Virtual Agent Chat.
The whole suite.
They bought the entire stack to modernize how they engage with their fan base. Or look at Caliber Collision, the auto repair giant. They have over 1,800 repair centers across the country. They bought Zoom Phone and Zoom Contact Center Elite. Why? To literally eliminate the cold call experience for their customers. They want a unified system where if a customer calls about their car, the agent or the AI instantly has the entire context of the repair.
What all these examples, Chelsea FC, Caliber Collision, MongoDB, Renza, what they all share is a fundamental shift in perception.
What's the shift?
These enterprises are looking at Zoom not as a single application, but as a unified data foundation.
Right.
They want one platform that handles the internal collaboration, the external voice calls, the customer contact center, and the autonomous virtual agents, all seamlessly sharing the same context and the same data layer.
So we have looked at the headline numbers, we've walked through the mechanics, the enterprise and online segments, and we have deeply analyzed how they are using AI to disrupt legacy contact centers and expand their total addressable market. This brings us to the future. What is management telling Wall Street about the rest of the year? Because as investors know, past performance is great, but the stock market is a forward-looking voting machine.
And management sent a very loud, very confident signal to that voting machine. They raised their full-year fiscal 2027 guidance across the board.
Let's hear the exact numbers.
For the full fiscal year, management now expects revenue to be between $5.08 billion and $5.09 billion.
Okay.
At the midpoint, that represents 4.4% year-over-year growth. And they significantly raised their profitability outlook. The new EPS guidance is between $5.96 and $6 per share.
So they are confident enough in their sales pipeline and confident enough in those AI product upsells we just discussed to tell Wall Street, hey, we're going to generate more revenue and significantly more profit than we promised you 3 months ago.
It is a classic beat and raise quarter.
But the raised guidance wasn't even the most aggressive signal they sent to the market. We need to zero in on the single most significant financial maneuver of the entire earnings call.
The buyback.
Yes. The board of directors authorized an incremental $1 billion share repurchase program.
This is a massive deployment of capital, and it requires deep analysis to understand why they are doing it.
Let's unpack the mechanics of a share buyback, because this is vital for understanding how a mature tech company manages its balance sheet. Zoom already had an existing buyback program.
Right.
They have $7.7 billion in pure cash and marketable securities just sitting around on the balance sheet. What does throwing another $1 billion at their own stock actually accomplish?
To understand a buyback, you have to look at the math of shares outstanding. Think of a public company like a pizza.
Okay, I like pizza.
Let's say the company is divided into 10 million shares, 10 million slices of pizza. If the company generates $10 million in profit, each slice is entitled to $1 of earnings.
Earnings per share.
Exactly. Now, what happens if the company takes its extra cash, goes into the open market, and buys 2 million of its own shares and destroys them, retires them?
Now there are only 8 million slices of pizza.
Right. But the actual size of the pizza, the underlying business generating the $10 million in profit, hasn't shrunk.
It's still a $10 million profit.
So now that same $10 million in profit is divided by 8 million shares. The earnings per share jumps to $1.25. By simply reducing the denominator, the company mathematically increases the value of every remaining share,
which naturally drives the stock price up, assuming the price to earnings multiple stays constant. But let's look at the specific scale of what Zoom is doing.
They had a previous authorization from the board of $4.7 billion. They have already executed $3.1 billion of that, so they had $1.6 billion left. By adding this new $1 billion tranche, they now have $2.6 billion in total current firing power to just step into the open market and buy their own shares.
But why do it now? Why is this the best use of their $7.7 billion cash pile? I'm going to push back on management strategy here.
Let's hear it.
If you are a technology company in the middle of the greatest platform shift since the internet, the AI revolution, why on earth are you buying your own slow-growing stock instead of acquiring an incredibly fast-growing AI startup?
It's a fair question.
Why not use that $7.7 billion to buy a competitor or buy a cutting-edge LLM company to supercharge your tech stack?
It is a completely valid critique, and it goes to the heart of capital allocation theory. The decision between M&A mergers and acquisitions and share repurchases comes down to one thing: valuation multiples.
Explain that.
Right now, the private market for AI startups is entirely disconnected from financial reality.
It's a bubble.
It really is. If Zoom wants to buy an AI company with $50 million in revenue, the venture capitalists backing that startup might demand a valuation of $2 billion.
Wow.
That is a 40x revenue multiple. It is incredibly expensive, highly risky, and dilutes the value of Zoom's capital.
So the ROI on acquiring a flashy AI startup is actually terrible right now.
Exactly. Conversely, Zoom's executive team is looking at their own stock. They are looking at their 40% free cash flow margins, their 80% gross margins, and their massive enterprise footprint.
Right.
And they are looking at the price Wall Street is currently assigning to their shares, which is trading at a massive discount compared to historical SaaS multiples.
Management looks at the stock ticker and says, Wall Street is undervaluing our asset. Our stock is cheap.
Right. If you have to choose between buying an unproven AI startup at a 40x multiple or buying your own highly profitable cash-flowing business at a massive discount, the financially disciplined choice is to buy yourself.
It makes a lot of sense when you frame it like that.
It is the ultimate vote of confidence from the C-suite. They believe the market is fundamentally mispricing their transition from video to AI.
And crucially, they're executing this massive buyback while still maintaining incredible financial flexibility. Yeah. Even after allocating this capital, they will still have over $5 billion in cash remaining.
A huge cushion.
So if a genuinely transformative M&A opportunity does present itself at a reasonable valuation, they still have the war chest to execute it.
Eric Yuan even joked about this during the analyst Q&A. An analyst asked about their M&A strategy, and Yuan essentially said, hey, if you know of any great startup companies with great technology, let us know. We are very open-minded.
It shows they aren't ideologically opposed to acquisitions. They are simply disciplined on price. They have the internal engineering talent and robust R&D spending to build the tech in-house, but the financial firepower to buy anything that accelerates their roadmap if the price is right.
And there's one more vital reason for the buyback that we briefly touched on earlier: offsetting stock-based compensation.
Right, the dilution factor.
When Zoom issues millions of shares to pay its engineers to build these new AI tools, it bloats the total share count. If they don't actively buy back shares to absorb that new issuance, the retail investor gets diluted.
The slice of pizza gets smaller.
Exactly. So a significant portion of this buyback program is simply housekeeping, sweeping up the newly issued shares to ensure the existing shareholders don't lose value.
So we've dissected the headline numbers and the constant currency growth. We have explored the mechanics of the net dollar expansion rate and debated the structural churn in the online segment.
Lots of moving parts.
We've done a deep dive into how custom AI companion and outbound AI virtual agents are completely reinventing the contact center market. And we've analyzed the capital allocation strategy behind $1 billion buyback.
It's a lot to take in.
It is. So it's time to bring it all together. The bottom line, we promised an opinionated takeaway on what all of this actually means for the asset.
Looking at the entirety of the financial and operational data, we are taking a decidedly bullish stance on Zoom following this quarter.
I am extremely bullish, but with a massive caveat regarding how the market currently perceives them. Let's start with the why behind the bullishness. Zoom is successfully executing a maneuver that kills most legacy tech companies. They are fundamentally altering their core identity while maintaining high profitability.
There was a specific phrase that CEO Yuan used on the call that I think perfectly encapsulates the entire investment thesis for the next 5 years. He stated that Zoom is shifting from a conversation-centric business to a completion-centric business.
Completion-centric. Let's really analyze the mechanics of that phrasing. What does it mean to move from conversation to completion?
Historically, Zoom was a dumb pipe. A highly reliable, phenomenal piece of infrastructure, but fundamentally just a pipe. Its only job was connecting person A to person B so they could have a conversation.
Right.
Once the conversation ended, Zoom's value proposition dropped to zero until the next meeting.
It was utility, like a telephone line.
Exactly. But completion-centric changes the paradigm. The value is no longer just in facilitating the talk. The value is in what happens after the talk. It is the software actively participating in the workflow.
They aren't just hosting the meeting.
Yeah.
Their AI is sitting in the meeting as a silent participant.
Right.
It is taking the notes. It is extracting the action items. It is instantly pinging the IT department's ticketing system to request a new laptop because it heard someone mention they spilled coffee on theirs.
Yeah.
It is automatically updating a client's status in the Salesforce CRM. It is drafting the follow-up emails. It has moved from being a passive utility to an active, autonomous participant in the workforce.
And the economic difference between a passive utility and an active participant is monumental.
It's night and day.
If you are an enterprise CFO, a passive utility is a cost center. You try to negotiate the price down every single year. But an active participant that automates administrative workflows, that is a massive return on investment.
Because it replaces human labor hours. Yes. That is why they are winning these massive seven-figure deals against entrenched competitors like Cisco, the government contractors, the hospital networks, the massive financial institutions like Raymond James. They are buying the completion. They're buying the automated workflow, not just the video connection. Okay, but I had to play the ultimate devil's advocate here. I have to bring up the elephant in the room that every bear points to when discussing Zoom.
Microsoft.
The Microsoft Teams threat.
Yes.
Microsoft Teams is bundled for free, or effectively for free, within the Office 365 suite. If an enterprise is already paying for Word, Excel, and Outlook, they get Teams. And Microsoft is aggressively rolling out their own AI, Microsoft Copilot.
They are.
If I am a CIO, why on earth am I paying millions of dollars a year for Zoom's completion-centric AI when I can just use the AI built into the Microsoft suite I'm already forced to buy? Doesn't Zoom's land and expand strategy inevitably hit a brick wall called Redmond, Washington?
It is the single most important competitive dynamic in software today. The good enough bundle versus the best in-breed specialized tool.
Exactly.
The bearish thesis is exactly what you just laid out. Microsoft uses its distribution monopoly to crush the specialized competitor. But the data from this quarter actively disproves that thesis, and here is why.
Break it down.
First, look at the contact center. Microsoft Teams is an internal collaboration tool. It is not designed to run a 5,000-seat outbound customer service operation.
Good point.
Zoom Contact Center is actively displacing legacy systems because it is built precisely for that high-volume external workflow. Microsoft doesn't have a cleanly integrated equivalent that scales with AI the way Zoom just demonstrated with the Renza outbound calling use case.
So Zoom is finding blue oceans outside of basic internal meetings.
Exactly. Second, let's look at the AI monetization mechanics. Microsoft Copilot is incredibly expensive. They are charging a massive premium, often $30 per user per month, for their advanced AI capabilities.
Oh.
Zoom is providing the baseline AI companion for free to paid users.
So Zoom's baseline AI acts as a defensive moat against the Office 365 bundle.
Right. Zoom is saying to the CIO, you can pay Microsoft an extra $30 a head for AI, or you can just keep paying your standard Zoom license fee and get the AI meeting summaries, the smart composition, and the workflow automation included. That drastically changes the ROI calculation for an enterprise.
And it explains why the net dollar expansion rate is holding steady at 99%. If Microsoft was truly crushing them with a free bundle, that expansion rate would be plummeting into the 80s as companies abandon ship.
Precisely. Enterprises are actively choosing to pay for Zoom because the specialized UI, the integration layer, and the specific contact center functionalities are vastly superior to a bundled utility.
So for you listening right now, here's the actionable framework. You need to completely purge the year 2020 from your mind when evaluating this company. Stop looking at Zoom as a work-from-home pandemic stock.
That narrative is dead, and if you are trading based on it, you are trading on ghost data.
You need to start evaluating Zoom as a highly profitable, deeply embedded enterprise AI workflow platform.
If you currently hold the stock, this earnings report is massive validation of your patience. The company is generating $500 million in free cash flow a quarter. They are actively retiring shares to increase your ownership percentage, and they are executing a brutal, successful land grab in the AI contact center space.
And if you are on the sidelines considering a position, you need to look at that 41% operating margin. You are looking at a management team operating with extreme, ruthless financial discipline while simultaneously successfully incubating a multi-billion-dollar AI growth engine inside the legacy business.
That's a real story.
Which brings me to one final thought, something for you to deeply consider as we wrap up this analysis. During the Q&A portion of the call, Yuan was asked about customer perception regarding AI. And his answer was remarkably, almost painfully honest.
Yeah, I remember this.
He admitted that right now, when enterprise customers think of true AI companies, they only think of the hardware layers like NVIDIA or the foundational models like OpenAI. He openly acknowledged that the market does not look at a software application layer like Zoom and immediately think AI powerhouse.
Because they are still burdened by the legacy perception, they're still seen as the video company.
Exactly. But let's look at the trajectory we just mapped out. Zoom is rolling out agentic workflows. Their AI is actively making outbound phone calls and updating CRM databases. They are building custom FineRA compliant LLM sandboxes for massive financial institutions. They are automating the entirety of corporate note-taking.
The underlying mechanics of the company have already transitioned.
They have. So the question isn't whether Zoom can execute the AI pivot. They already are. The question for you is, how long will it take for the broader market to wake up?
It's the million-dollar question.
How long until Wall Street analysts stop applying a legacy slow-growth software discount to Zoom's valuation and start modeling this stock with a true premium AI multiplier?
Because the history of the stock market tells us that when a massive shift in narrative finally occurs, when the market realizes the fundamental nature of an asset has changed, the repricing of that asset can be incredibly swift.
It's the ultimate arbitrage opportunity between perception and reality. The numbers are undeniably proving the reality. Now we just wait for the perception to catch up.